Guys, welcome. Hang out for a second. Just waiting for people to log in here as they kind of slowly start to pour in. Everybody, if you're already here, just kind of make yourself comfortable for a little bit. We're going to get going probably at about 2:05 just to kind of give people the chance to get in it and get settled. So till that time, we'll see you guys in a second. All right, guys, we're going to kick it off. Excuse me, a little under the weather. All right, guys, so welcome to today's topic. We're going to be talking about money. I'm going to give you guys a little bit of some resources that you can use to start investing with, start playing around with, getting some good information from. I definitely encourage you guys after this video to go back and rewatch it. I'm going to give a lot of information, and I'm also going to set a lot of groundwork for stuff that I'm going to try to not have to go over. So there's a good chance that in later topics, I will kind of touch over a lot of the stuff that we've talked about today, but for the most part, I'm not. So I ask all of you that are watching this to please go back and rewatch this video. All right, so without further ado, we're going to go ahead and get started. In order to kind of organize my thoughts and kind of, stay on topic and keep focused, I made a PowerPoint. Real quick, just PowerPoint is not something that's like a school PowerPoint. Don't be nervous about that part at all. Also, this is really something good. I will share the PowerPoint if people need to. So go ahead and just drop your email address in the comments or email it to me or text me if you have my number. I'm definitely available. All right, my bad. Sorry, guys. Adding a quick message. So I will share the PowerPoint after we're done too. So we're gonna go ahead and get started. I'm getting ready to go ahead and bring this up. So give me 1 second here. All right, guys. So we're gonna go ahead and get started. So today, as it says, I just talked about before, we're going to be going over some general information. We're going to be going over money. And then finally, what's all that mean? We're going to be going over the foreign exchange market, also known as the Forex market. The first thing that I want to say, I want to make this disclaimer. Investing is not gambling, okay? Yes, there is risk involved. Yes, the outcome is uncertain. Yes, you can potentially lose. Yes, people do lose, but people do win as well. Just because the outcome is uncertain doesn't mean that it's gambling. I'll give you an example why. You can't go up to a blackjack table and say, hey, how many times in the past 10 minutes has a joker been pulled or a jack been pulled? Or how many times in the past, day or so have people won more than $20 to $30? The dealers are going to look at you like, I don't know, I don't get paid enough, go somewhere else, right? So that's just one example to show you why investing is not gambling. There's numerous articles to kind of point out the math of how gambling is kind of a rigged game, so to speak, in which case the casino is not designed to really give you money. The stock market is not designed to give you money either, but it's not as controlled as the casino games are. So we're going to move on a little bit now. I just had to make that quick disclaimer because a lot of people like to talk to me about that. So first, we're going to get into some general information. So the first thing that we're going to talk about is just some quick websites. All right, so I'm just going to bring them up right quick. So the first one we're going to go over is called Investopedia.com. Me personally, I'm Investopedia.com biased. This is what I go to for everything. I go to Investopedia.com when I have some of the most basic questions about things that I just don't even know how to explain, right? So I use it for like a lot of papers if I'm trying to explain things. That it really gives a good breakdown. So one thing that I also like to use is this book right here. It's called The Guide to Money and Investing. This book is essentially like a For Dummies book on every single capital market, foreign exchange market, options, stocks, bonds, futures, everything, you name it, it's pretty much in this book, and it talks about it and it touches on it with a lot of good pictures. So I definitely encourage you guys to buy this book. The book is probably about $5 almost everywhere, Barnes & Noble, eBay, Amazon, you name it. So definitely buy that book. Another website that I like to use for some good general information is called investing.com. It really gives a lot of good news articles. You can look at a lot of charts, a lot of graphs. Today, when we start going over the Forex market, we're going to start talking about a lot of these charts and graphs. And you're going to see that these charts and graphs, even though today we're talking about the foreign exchange market, you could use these to do stocks, options, you name it. Sky's the limit. So after that, we have some brokers, right? So what good is information if you don't know where to start investing from? So one good broker is TD Ameritrade. You can also go with T. Rowe Price. I'm not going to advertise on behalf of any of these. Scottrade is a good one. E-Trade is another good one. And then you have Fidelity. These are pretty much 5 big ones. Oops, sorry about that. Let me go back. So these are pretty much 5 big ones right here. There's another website called stockbroker.com. You can use that site as a way to kind of compare brokers. It has a plethora of brokerages on that website. Way more than these 5 that I posted. So don't think that these 5 are a finite number, and these are the only 5 resources that you can pick from. A lot of these places have offices that you can walk into where you can meet with a financial advisor. They're a lot more professional than I am as far as their knowledge base goes. And they also have websites. You can use their website to get information. You can reach out through their website. You can start investing through their website. There's numerous ways for you to get your hands wet and start diving into the investing world. So now we're going to talk about some resources for the foreign exchange market, and keep these resources in mind. You might want to kind of take a note on these as we go through this, because like I said, we're going to touch back on the foreign exchange market later on in these slides. So pay attention to these resources. I'll try not to spend too much time on them because I want to encourage you guys to go back and actually to do your own research. That's another thing. None of this information that I'm giving you is like the end all be all of everything that you need to know. I'm not going to give you anywhere near the level of information that you need to become an avid, fluent investor. This is more so to get you guys familiar with things and to give you guys a foundation and to kind of get you guys going a little bit. You know what I'm saying? So, I mean, definitely please reach out to me if you have questions. I'm definitely always available. I'll leave my email address as well. You can respond to this. I will respond back. Please forgive me if I don't respond right away. So yeah, so we have the foreign exchange market. So the first website that I highly recommend is called babypips.com. BabyPips is a good website for learning. They take you through this class. They start you off with what they call like preschool and then like kindergarten. So it's a really good way for you to kind of get some good information on how to use what I'm going to give you in a more broad and more advanced and more personalized and detailed spectrum. So after BabyPips, you have Daily FX, right? Daily FX is another good informational website, but as compared to BabyPips, it's a lot more technical. So you might come across a lot of things that you read that you absolutely don't understand what it's talking about. BabyPips would be a good place to get started. The news is actually the best place to kind of get your feet wet as far as the language goes. BabyPips is going to give you really basic fundamental language, but that's not the way that investors and speculators and people that operate in these markets talk. So a good way to kind of get up with the lingo, so to speak, is to watch the news and then go to these websites and then see what they're talking about in a more technical way. Forex.com. Forex.com you can get information from. It's also a brokerage platform as well. There's also FXCM. I don't believe I put it in this slide, but there's another site called FXCM. You can go there as well to make trades and get information as far as news, things like that. Owanda, just another one as well, kind of like FXCM and Forex.com. So one thing that you guys are going to need to do is become your own personal economist. And I will next week be giving kind of a more in-depth talk about how to go over some economic info and what the reports say. A lot of these reports use really technical language. It's not hard to understand. It just kind of takes a little bit of training and working with to kind of get a good grasp on it. But you do need to know how the economy works. You need to know how every economy works for every market that you want to dive into. What I mean by the economy, I mean, not necessarily in a broad sense, but you need to know enough about it to become an informed investor, right? So whatever it is that you want to do with your, I don't know, investing potential, I guess, so to speak, no matter what it entails, you're going to need to know something about the economy. So one report that you can find is reports on the Federal Reserve economic data. I just use this report to do I just used this database to do a report myself. I actually used all of my data came from the Fed, and I had a plethora of variables. So the Federal Reserve economic data is the St. Louis Fed, stlouisfred.com, I believe is the website. You can go there, you can get all sorts of economic reports. They actually have a few foreign economic reports. However, keep in mind, this is for US information primarily, but you can get things from exchange rates, stock market data, to housing prices, to job markets, a lot of good information on Fred. I definitely encourage you to kind of go there and play around with it a little bit. Another good website is the BEA, stands for Bureau of Economic Analysis. The BEA gives reports on the economy, but primarily, you want to go to there to find quarterly GDP reports. If you don't know what that is, don't worry about it. I'll talk about that, like I said, next week. BLS gives Bureau of Labor Support statistics. So they give like unemployment data, NFP data. They also give what's called CPI data, stands for Consumer Price Index. That's really a good report that really impacts economic markets. Excuse me. That's another good report that impacts economic markets a lot. Really heavy report, not hard to understand. And once again, like I said, just really technical. And then you have a Bloomberg economic calendar. So the Bloomberg economic calendar is a good resource because it will tell you when, the Federal Reserve is going to release something that's important, or when the BEA has a report that's coming out that, might be important, or when the BLS is going to drop its CPI data. One report that's really common, it's called NFP data, stands for non-farm payrolls. That's a fancy way to say it's the unemployment data, right? So when people talk about, oh, the unemployment rate is this, that, and the other, they're talking about NFP data, right? So you can go there to find it yourself. You don't have to wait for the news to kind of spoon feed you some information. Then you have business and financial news. And like I said, news is definitely an important resource as well, because it might not necessarily give you, direct information, but there's a lot of implied information that you can get from the news. For example, if you hear that, I don't know, Israel is getting ready to have a huge war with the Middle East, well, you can probably expect, that's going to, impact oil prices, right? So a lot of things that involve oil, like airlines and things like that, are probably going to increase in price and so on and so forth. But it also gives a lot of good technical news too. One website that I personally prefer is Bloomberg.com, and there's also Reuters.com. Bloomberg is a really good informational source as well as news. You can also go there, like I said, to find their economic calendar and so on and so forth. You can also use CNN Money. You can just go to CNN.com, and from there, I believe you go to CNN Money. CNBC is also a resource that you can use for some news and market information, as well as Fox Business News. And then there's also MarketWatch.com. I prefer Bloomberg and Reuters personally because they're less politically biased, right? So all of these sources are really good. CNBC is democratically biased. That's why it has the blue arrow. And then you have Fox Business News that tends to have a pretty Republican bias. Now, although they do give political bias, there is still information in these markets. And there are people that use those news sources and believe them 100%. So they might be really Republican and only watch Fox News. And then they're going to use that information to go make investments. So you should definitely be fully informed. No matter if you're a Democrat, Republican, whatever, that doesn't mean that you should ignore information. So now we're going to start talking about a little more technical stuff. We're going to get into the functions of money, right? And a lot of you saying like, well, I know what the functions of money are. You spend it. Not necessarily. This is good when you want to talk about things like Bitcoin. I'm not going to be talking about Bitcoin at all. This talk, we can do that probably at a later date. But this is definitely a kind of some of the fundamentals, exactly what the purpose, I guess you could say, for what money is. So the first thing that money is, it's a unit of account. What does that mean? Money serves as a unit account, means it's the standard in which you say how much people owe you or how much you have to pay for something, right? So when you go to buy a car, the car salesman tells you that the price of your car is going to be $20,000, not 52,000 t-shirts. You know what I'm saying? So that's just something that I know we all think is pretty basic, but we don't really think about too much. Another thing that money is, it's a store of value. That basically means that the denominated value on the dollar or $100 bill or $5 bill is going to be that value at a later date. So when you get paid $5, that value is going to be $5, right? It doesn't necessarily have to be a denominated value. We could, say this one iPhone, I'm going to pay you 3 iPhones, and that 3 iPhones carries a certain value. It's going to contain that value into the future. Now, however, keep in mind that that doesn't account for the change in prices. So you can still get paid the same, $2,000, $2,000 a month. But if prices start to increase, that kind of takes away your purchasing power. And that's also something I'll start talking about next week as well. And the last thing that money serves at is a medium of exchange to facilitate transactions. Basically means we don't barter trade. And these three reasons are also reasons as to why we cannot live in an economy without money, right? We have to quote prices. We have debts. We need to have value. We need to know that when you get paid, that value means something, right? And you also need to barter, or not barter trade, right? If you want to go buy something, you have to have what's called a double coincidence of wants, right? So if you want to go to the grocery store and you need to buy eggs, well, the grocery clerk might be like, well, I need gas. Well, if you don't have gas to give them, you now have to go get gas. So money is a way to kind of take out that middleman exchange, right? So now we're going to talk about exchange rates. An exchange rate is the value of one currency relative to another. So back to when I said money has a store of value, that value is actually a relative value, right? So when you talk about things are valuable, it's in relation to something else. A car is X amount of dollars. That dollar amount is the value of the car, right? So we also have value when we talk about money, and we do that in terms of money. So an exchange rate is essentially comparing value of one currency to another currency. And this plays a factor because this is essentially what the foreign exchange market is. It's speculating on exchange rates and their fluctuations. And we're definitely going to get into this in a lot more detail as we continue on. So just like I said, it's a comparison of currencies. So when you do this, one currency is going to be the base currency and the other currency is going to be the quoting currency, right? In this example down here, I put €1 when exchanged for $1 is worth $1.20. To say that in technical terms, you'd say the euro dollar is $1.20, you know what I'm saying, or 1.2 or whatever. But it's basically what it means is when you exchange in €1, you will receive $1.20. And in reverse, in order to get €1, you have to give up $1.20. This is just an example. I don't know what the price of the exchange rate, of the euro dollar right now is. Please look that up yourself. So exchange rates fluctuate all the time. Exchange rates fluctuate on a minute basis, 5-minute basis, hourly basis, daily basis. They fluctuate often, and we'll get into some of the reasons as to why they fluctuate and why they don't fluctuate as well. But the amount of fluctuation is known as volatility. It's basically just how much something has changed. There's 4 major currencies, and these 4 currencies are the 4 currencies that I want you to play with. I don't care if you've been to Zimbabwe and you think that Zimbabwe was a great country, so you just love the Zimbabwe people and you want to do everything you can to learn about Zimbabwe. That's great. Learn about Zimbabwe in your own capacity, do everything you can, but for the purpose of trading with currency, don't trade the Zimbabwe dollar. Okay, trade with these ones. These currencies that I'm going to give you are considered stable currencies because they have a quote unquote stable economy. That doesn't mean that the economy doesn't fluctuate. Every economy fluctuates. What it means by stable is there's a lot of agencies that report on the state of the economy that are well trusted. They're also pretty big economies. That's another thing, is the size of the economy. And the volatility, as I mentioned before, so the fluctuation isn't huge, right? So let's say we're going to use the euro dollar comparison, right? One day the euro dollar might go from like 1.2039 to like 1.2050, right? That's only like 11 points difference versus 1.2034 to 13.5508, right? That's a huge jump in price. And the reason why that's not good is it's hard to predict things like that. When things are really moving around, it's kind of hard to predict the direction that they're going, right? Things are kind of shifty. So we're going to get into these currencies really quick. So the first currency is the euro. That's one of the biggest currencies in the world. It's comprised of a bunch of different countries that that figured it's easier to have one single currency. The second one is the British pound. You may have heard of things about the Brexit or the British exit. Look that up on your own. I'm not going to get too much into that, but they're basically talking about the British economy and the effects of, or the impact that that's going to have on the British pound. The third one is something that we all know if you're watching this in America, the US dollar. And the last one is the Japanese yen. These four currencies are what are known as the major currencies. There are also things that are called minor currencies that also have a stable economy, but they're not as big as these four. The other four, just to get into them, are the Swiss franc, the Canadian dollar, the New Zealand dollar. I'm forgetting one. Swiss franc, Canadian dollar, New Zealand dollar. I can't remember the other one. Anyways, that's not important though. Look those up on your own. Babypips.com is a good place to start for that information as well. So these currencies are, like I said, are also supported by some of the largest economies. And if viewed as stable, like I said, stability doesn't mean that it doesn't fluctuate. Okay, so take that thought out of your mind. I know it's really easy to start thinking that, you know, because something's stable, it means that, you know, flat and doesn't move. It's not the case at all. So now we're going to get into the foreign exchange market. And in this part right here, we're just going to be talking about what the foreign exchange market is, how it operates, who operates it, so on and so forth. So I didn't put it in the slides, but there's no overall governing authority of the foreign exchange market. The foreign exchange market is a global market. So you have the market like the US stock exchange, right? The US stock exchange is monitored by US agencies, right? And you have other stock exchanges around the world that are monitored by, you know, those countries' agencies respectively, right? The foreign exchange market is, it can be manipulated. It has been manipulated, but it is basically what you kind of consider a free market. Not necessarily, but it is. So as I said, the foreign exchange market is better known as Forex. If you want to sound a little more up to speed with your knowledge, start calling it Forex. Don't call it foreign exchange. Anybody that hears Forex knows what you're talking about. The Forex market operates 24 hours a day. Like I said, it's a global market. So the world is a 24-hour thing, right? We spin. So there's three main financial regions. Going from east to west, you have Tokyo, you have London, and you have New York. Now, why are these three the main financial regions? They're the main financial regions because they operate the main parts of the world. I know this sounds really weird, and I'm kind of jumbling up my words a little bit, but basically, Tokyo, look at it as like Tokyo kind of controls Asia, right? Tokyo's stock exchange is one of the biggest Asian stock exchanges. The London Stock Exchange is one of the biggest European stock exchange, and the New York Stock Exchange is one of the biggest American, so North and South America, stock exchanges. So it kind of segments the world into like three different regions and zones, right? So a lot of these regions overlap in time. And what I mean by overlap is, I mean that their stock market opens and closes when another market is still open. So Tokyo will be open, and then as it's open, London will open, and then Tokyo will close, and then New York will open. So it's kind of like a little play a little bit, right? But you can see how it makes it 24 hours because there's always a major market that's kind of operating. And even if there's not a major market operating, there's what's called off hours trading, where people still trade on the Forex market on Christmas. We'll talk about that much later in the future. So Forex is one of the largest markets as compared to the stock market that does like in the millions. Forex does 5 trillion daily, right? So that means that $5 trillion are transacted in the Forex market daily, right? And a lot of you guys are thinking like, wow, people invest 5 trillion daily. Yes, but not the type of investing that you think about. So speculators and corporations participate in the Forex market. A speculator is what people think about as investors, somebody that guesses on what the price is going to be, and they try to make an investment based just solely on the price, right? Now you have corporations that operate in numerous countries, right? So let's pretend you're an American-based company and you sell goods in America. You actually sell goods all over the world. Let's say you sell goods all over the world, but for the purpose of this example, you have a facility that operates in Canada, and you have Canadian workers that are going to need Canadian dollars, right? Well, you sell your products in America. So in order to pay your workers, you have to now take the dollars that you made from your sales and convert those to Canadian dollars on the exchange rate, right? On the Forex market. So that's just one example of what I mean by corporations operate in the Forex market as well. The difference is, like I said, they're not waiting for a certain price to come out. They say, okay, we have this money. It's the end of the month. We now need to pay our employees. We're going to convert this, and they go ahead and do it. These, however, you'll see by huge increases or decreases in the price when you start looking at charts. And the huge increase and decrease is either usually a quick market reaction, or a huge company either just bought or sold a currency. I know I'm kind of getting a little ahead of the game here, but that's just one idea of where this is going. So how do you make money, right? What's the point of learning all this if we don't make any money from it, right? So anytime an exchange rate changes, it's the potential to make money. So if it goes up or down. For this purpose of today, we're only going to be talking about if the exchange rate goes up. However, if the exchange rate goes down, you can still make money too, just like you can in the stock market as well. But like I said, for the purpose of all these examples today, we're going to pretend that the exchange rate goes up. So you're only buying the currencies. So pretend that you want to buy 100,000 units of the euro dollar currency pair at $1.20 today, right? And I know you're wondering, like, why is there two other zeros behind that? We're going to talk about that later. There should actually be another third zero. So let's pretend that you want to buy 100,000 units of the euro dollar currency pair, right? Sounds weird. All that basically means is you bought 100,000 units or 100,000 euros at $1.20 per euro, right? It's going to cost you $120,000. So now you have this 120,000 or 100,000 euros, right? And let's say tomorrow the price of the exchange rate increases by a nickel, right? And you're like, whoa, a nickel, that's nothing. It's a lot. So if tomorrow the price increases by a nickel and you sold your 100,000 euros, you would now get $125,000, leaving you with a $5,000 profit. So that just shows you how you make money buying and selling currency. I'm teaching you guys this because this is what got me involved in investing. I was in the military, and somebody came to me and told me about some investing that they were doing. And I thought he was talking about stocks. And he told me that it was with currency. And to me, that sounded really weird, because I was like, how do you buy currency? You know what I mean? Like, what do you mean you buy money? And he's like, yeah, I operate on the Forex market. So he kind of gave me a really brief tutorial. When I mean brief, I mean it was like, this is the platform. This is what Forex is. Go ahead and get started, right? And that was it. From there, it kind of took off. But this is a really fundamental thing that you guys can do in order to kind of get started. This is what got me started. So this is what I'm using to get you started. So back into it. This is how to analyze the market. I'm going to go into this really briefly, and we're going to touch this a lot more in depth when we talk about economic indicators and things like that as well. So there's two ways to do it. The first one is fundamental analysis, and then you have technical analysis. So with fundamental analysis, you're going to use economic indicators to predict potential market fluctuations, right? So you're going to go to the CPI report on the BLS website, and you're going to say, all right, the CPI is going to do this, and I'm going to make this trade based on this, right? So basically, it's even though it's called fundamental, it's basically instinctual analysis, right? What do you feel, right? How do you feel the market is going to react to this? There's also something called sentiment analysis, to where you're really just guessing to how people think, right? One thing to point out is the market, it sounds like this huge, broad, far off, out of reach thing. It's actually not. The market is just people. You're not guessing against some random robot machine. There are people that use machines and bots like that to make trades. However, at the end of the day, it's still a person that makes the decisions overall. So the market is just people. So when the price rises or falls, it rises or falls is based on people's expectations and people's beliefs about what the value should be. So supply and demand are in full effect. We'll talk about that, like I said, next week. We'll really get into some more factors of supply and demand and what it means to move supply and demand and why supply changes or why demand changes, not just the price. And you'll be able to use that video to kind of go back with this one and really start getting your feet wet. And like I just said, the sources of supply and demand are in full effect at all times. Okay, never forget that. Like I said, the market is people. It's people's choices to buy or sell something, right? But you also have technical analysis too. The technical analysis doesn't care about the fundamentals, all right? So it does not take into account economic factors at all. People that trade purely based on economic analysis don't read GDP reports, don't read CPI, can care less about what the stock market is doing. It's irrelevant to them. Why? Oops, sorry about that. It's less intuitive than fundamental analysis, but they believe that all information is contained in the price. That's really technical. I know it sounds really weird, but they basically believe that the price represents everything in the economy, right? So you don't need to know what this report said because the price is already reflecting the outcome. So the way that they do that, we'll get into a little bit later. So first, we're going to talk about how to speak Forex. Okay, these are some things when you start reading the reports and start going to things like daily FX and baby pips, you'll start to see these terms come up again. But these are some really basic terms to how to sound knowledgeable when you talk about Forex and how to tell people what you're talking about. The first one is called bid. So the bid is the price to buy. So when you say I bid a currency, it means I bought a currency, right? Another one is called the ask, right? So you have the bid and ask. Ask is the opposite. It's the sell price. The spread is the difference between the bid and the ask price. The spread is the fee that the broker charges. Usually it's pretty marginal, right? It's not more than like, I don't know, I think I've seen like $1.50 a couple times and things like that. But the fee, it fluctuates as well from broker to broker. But it basically is it's just the cost of using that service. But it's never a huge amount. So we're not talking about, you know, some $50,000 cost to you to trade a currency. And we'll talk about the costs of trading as well a little bit later. A pip, this is kind of a technical term. A pip is a percent change in a currency, right? So it's 1/100th of a percent change, right? To make that more simple, I put it's 4 decimal places or 4 places to the right of a decimal, right? So that's why I said before that 1.2000 looked kind of weird, but we'll talk about that later. So that's why. So if that last digit was a 1, that would be an increase of 1 pip because the price changed 1/100th of a percent. Basically, think about this as we have pennies. Even though we don't have anything smaller than a penny, the Forex market breaks a penny down into a penny. I know that sounds weird, but it's basically a penny of a penny. That's really the most fundamental way that I could try to explain that. If you don't know what I'm saying still, ironically, go to babypips.com and they'll definitely talk about a little more. Also, you can go to investopedia.com too. Investopedia will give you an example of what a pip is, a definition, a lot of good information as well. Then we have a lot. So you don't buy and sell like $1 to €1 individually. You do it in groups, right? There's really no way to make money if you do it like on a one-to-one basis. Nobody's gonna care to profit, you know, a tenth of a penny. You can't even put that in your bank account, right? So they do it in what's called a lot. Now, a lot basically just denotes a size. So a standard lot is 100,000 units. You guys can't say dollars because you're not always talking about dollars. I know it may sound weird, like why is he saying units? Think about it as shares. It's 100,000 shares, right? I know you guys may or may not have been invested in stock market, but I know everybody knows what a share of a company is, right? So think about it as you're buying 100,000 shares of a currency. Now there's infinite shares of a currency, right? You buy however many units you want to. It's not like you're actually pocketing the currency. This is all transacted on a computer, it's basically written into a code. So yeah, you also have things that are mini lots. So a mini lot is like 10,000 micro lots, nano lots. So all kind of like breaks down, right? Now the thing about a lot is, even though you might think like, oh, I don't have $100,000 to trade, you don't need that. You can use what's called leverage, in which you borrow money. So some brokers offer different rates of leverage. You can get leverage at 100 to 1, 10 to 1, 5 to 1, 1 to 1. Basically what that means is for every dollar you invest, your broker gives you 100 times that amount. So if your leverage is 100 to 1, for every dollar you invest, your broker gives you 100 to invest, right? So that's how you're able to really make some money. Because like I said, if you're doing this on a small scale, you wouldn't profit too much. You really need a lot of units here to capture the difference. I mean, just look at the example that I used prior, right? The exchange rate only changed a nickel, yet you had 100,000 units of it, right? So you profited $5,000, right? So that just goes to show you how the impact of leverage works. But it's also a double-edged sword, okay? So you can gain 100 to 1, right? But you can also lose 100 to 1 too. So I don't recommend that when you start that you use any form of like major leverage. I will say this though, we're going to cover this at the very, very end. Open up a demo account, right? On FXCM and Forex.com and Awanda, you can open up an account that's basically like a fake account, right? So you can start trading based on market prices like you're really trading, but it's no money. So you're not profiting anything, but it's a good tool to learn. It's a good tool to scrape your knee and bang your elbow without really getting any real losses, right? If you start losing real money, you're really gonna just say, you know, forget this isn't for me, and you're gonna kind of fall into the wayside with it. So I really encourage you for a good amount of time, even when you feel like, oh man, I got this, I'm comfortable with it. I recommend personally spending a year with a demo account, because that year will give you a lot of information about how currencies fluctuate at different times, right? So right now, the dollar could be really strong because we're at Christmas time and sales from retail stores are starting to pick up, right? Or, you know, you might want to find out what happens to the dollar when we hit a really big economic scare, you know, when oil prices skyrocket or things like that. So you should really give yourself a lot of time to see how currencies kind of react to different things. And we'll start getting to that, like I said, a little bit later too. Right. But really, like I said, leverage is a double-edged sword. So you can gain by 100, you can also lose by 100 too. And margin is the percentage of the purchase price that you need in order to invest, right? So your broker will say, all right, we'll give you, 100 to 1 leverage. But if you want to buy something worth, 120,000, dollars, so to speak, you need to at least be able to put down $2,000. And now it's expressed as a percent, right? So it's the percent of whatever you want to buy. That varies from currency to currency. I think the last trade I made was with peso, and I think the required margin was like 2%, right? So however much you wanted to invest, you had to have 2% of that in your account already. But with a demo account, I don't believe that margin really matters because they give you a lot of money anyways. So you can, I think you start off with like up to $10,000 if you want to, which is a pretty decent amount of money, like I said, considering that you have leverage and margin. Once again, go back to babypips.com or Investopedia if that really doesn't make a lot of sense. This is how you read a price quote on Forex. So right here, you have the currency pair. So this is the euro dollar. This L right here represents the low. So the low price. This is the high price. This right here is just the time. That's not really relevant. This is what a real, I guess you would consider it an advanced rate. That's what they call it on the platform. This is what an advanced price quote looks like, right? So right here you have the buy, right? So it's really $1.40, right? And then 38, right? This 38 right here is a fraction of the penny, right? But this is the fluctuation right here, right? And so these will change all the time by like 2 or 3, 4 or 5, whatever. It goes up all the time, all the time. Once you guys open an account and get on a platform, you'll start seeing it for yourself for sure. But one thing that also I want you guys to keep in mind too is that even though I'm talking about you can do this on a computer, you can also do this stuff on your cell phone as well. It's not really user friendly, but if you want to just get in and not even look at a chart and just say, hey, I'm just gonna put up, 2,000 on a euro dollar or the dollar yen or what have you. I'll do that on my phone right quick. You can do it, no problem with the blink of an eye. Getting back into this though, don't worry about this rolls right here, roll S and roll B. This is the margin. This is the lot size, so 2.1 lots. Sell, so this is the bid price. This is the ask price, right? So that difference of 0.0002, so 3 zeros and a 2 at the end, is what the broker profits when you execute this trade. So like I said, there's 2 ways to trade that are basic. You have fundamental analysis and technical analysis, right? So fundamental analysis, we're going to give an example really quick of a fundamental analysis strategy, right? There's infinite amount of fundamental strategies that you can pick and choose from. This is a simple strategy. So first thing that you should do is you should pick a major, once again, major currency. So the euro, the pound, the yen. I left the dollar off because it's going to be the exchange rate automatically between the euro and the dollar, the pound and the dollar, and the yen and the dollar, right? So you really only have 3 choices to choose from, but pick one of these 3 and love it, study it, look at the graphs, look up information, look up news, right? And find an economic calendar in which you prefer. So Bloomberg has an economic calendar. MarketWatch has an economic calendar. You can type in to Google economic calendars. An economic calendar, it's going to give you the events that kind of may or may not move the market, right? So it'll tell you when unemployment data is coming out. It will tell you when the sales report data for the quarter is coming out, right? So the next one that's going to be coming out is the quarterly data for the 4th quarter, which kind of encapsulates the Christmas season, right? So people are kind of speculating right now on what retail sales are doing. That's the report that comes out. So find an economic calendar, and it'll tell you which reports are relevant and which reports aren't really that important at all. You may find a report though that the calendar views as being, moderate influence, where you may put it as high influence, right? And you can pick and choose which reports you want to use and which reports you don't want to use. Also keep in mind the economic calendar, it's going to be really, really, really detailed. You're going to see a whole bunch of things from a whole bunch of countries. You can factor out which countries you do and don't want to look at, right? So you can say, I only want to look at reports from America, right? Matter of fact, once again, keep in mind, like I said before, when you're doing this against another currency. So you're actually going to have to be monitoring two countries at once. So we live in America, right? So we see the news. We know how things are here. So you don't have to do so much research. You still have to research, but you don't have to do so much research to kind of find out the status of what you feel the value of the currency is worth here. But you're going to have to do research on another country. For example, either the Eurozone. So if you do the Eurozone, you're going to actually have to study the Euro as abroad, because as I said before, if you don't already know this, the Euro is comprised up of a bunch of different countries. So unless you want to go individually and study the monetary or the fiscal policy of all those countries, you can't really do that. You can study Eurozone monetary policy as well. You can also do it with the British pound. The British pound is really good right now because they're in what's considered the Brexit crisis. I'm not going to get into that, but basically Britain wants to rewrite its trade laws and kind of branch away from the Eurozone. It was really at one point, it was pretty much attached heavily with the Eurozone because London is really close to Europe, but they're trying to get away from that. So right now there's a lot of things going on with that. So now would be a great time to kind of get into that and see how, what happens in the news impacts the price of the pound and the dollar exchange rate. And then you have the yen, if you want to look into the Asian side as well. So before the report is released, what you're going to want to do is you're going to want to look at the price of the exchange rate where it's at, right? So I'm going to go back to the euro dollar exchange rate of $1.20 or 1.2. Let's say it's at 1.2. You're going to look at that report. You're going to say, all right, I think the market is going to move here. Put your little guess in. And then after the report comes out, go back and see, how far you missed or not. We're going to talk about what happens if you predict wrong and how to kind of prepare yourself for a wrong prediction or what's called if the market moves against you. So basically, if you just bought a currency and the exchange rate starts going up and you're like, oh, this is really good. And then, you go to sleep one night and you forget to check your account for maybe a couple of days. You forget to check your account for a couple of days and the exchange rate, starts dropping, you're going to start losing money. So there's a way to kind of mitigate that. And we'll talk about that a little later on. But the purpose of that for the economic calendars is, like I said, is just to kind of get an idea for how the market moves when different reports are released, which is why I said you shouldn't get a real account or a live account trading real money right away. You should kind of give it a good amount of time to see what happens when these reports come out. To see just kind of to what the market does. All right. You can also go back in time. So you can go back and look at previous reports and say like, all right, when was the report released in June for, NFP data and what happened there? You can kind of go back in the graph, and I'll show you guys what the graphs look like a little later, but you can go back in a graph and make your own analysis and say, this is kind of what happens when this happens. And it kind of follows a pattern, right? History repeats itself. Even though things change and things are unpredictable, they're not completely unpredictable, right? People have patterns. We all operate in patterns, whether you like to believe it or not. Your life is a giant sequence of different patterns that you do. All right. So we all have patterns that we operate. And the market, as I said, is not some giant random force. Excuse me, let me plug in my computer, guys. Sorry about that. 1 second. All right. So yeah, like I said, the market is not some giant, out of reach, far off force. It's people, right? So people have patterns. So the market has a pattern as well. So you can go back and kind of look at some of the past patterns and make your own analysis of the future. We do that with a lot of things. So an advanced fundamental strategy is called the carry trade. I say this is advanced for the purpose of this lecture. This is actually a really basic fundamental strategy. So the carry trade is basically when a speculator profits from the differential in the interest rate between two countries. All right. So let's pretend, to make this example simple, that the exchange rate between country A and country B is 1. All right. The interest rate, though, in country A is 5%, and in country B, it's 10%. This is not realistic. The interest rate in America, I think it's like 1%, barely, a little over 1%, right? And around the world, it's pretty close to that too. But just to make this a little more understandable, we'll pretend that country A is 5%, country B is 10%. So you borrow 100,000 units or one lot from country A at 5%. So it's going to cost you $105, right? You can even do this at a bank. You can go into a bank and get a loan. Now, once again, like I said, these interest rates are not real. These are completely made up. So don't go into the bank and be like, yeah, I heard you can get 5% in an interest rate. No, they're gonna look at you and be like, sorry, bud, not here. But so anyways, though, but you could do this though. If the interest rate was at 5%, you could go get a loan for 5% and reinvest that money at 10%. So that means basically you borrow in country A for 5%. You take that money that you got, they're going to give you $100,000, but it's going to cost you in the end, an extra $5,000, right? But you're going to take that $100,000, you're going to put that into another country, and you're going to invest it where you're going to get 10%. Let's pretend you invested in another savings account that offers you 10%. So you get a loan worth 5% at one bank. You go to another bank that gives you an interest rate of 10%. You just made a 5% differential. And once again, you profit $5,000. It's called the carry trade, right? You can do this with the Japanese yen. The yen is a really good currency that a lot of investors do carry trade off of. We'll talk about how to do a carry trade in the future. I want you guys to get in here on your own and kind of delve for yourself a little further about what a carry trade is and exactly how to go about doing that. If at the end of the day, Investopedia and all these resources that I give you make no sense, please reach out to me. I'm not unavailable. I'm definitely reachable. Like I said, comment on this video and I will definitely get back to you. You can also use YouTube as well. YouTube has a great resource for kind of getting your feet wet as well. And actually, you know, if you want to take yourself to the next level, you can use YouTube as well. So now we're going to go into the technical side. Remember, I said there was two strategies that we're going to get into today. So you have the fundamental side where we kind of look at a whole bunch of economic reports and indicators and things like that. But then you have the technical side. And I'm going to try to take a little more time with this here. All right. So the technical side doesn't care at all about the economic reports or anything like that. Like I said before, all information is contained in a price. What you're going to do, though, is you're going to use historic trends from the prices, and you're going to try to say, in the future, this is what the price has done. So, or in the past, this is what the price has done. So in the future, this is what I think the price is going to do. All right. We're going to get into how you go about doing this a little more specifically in a couple more slides. Hang with me, guys. We're almost done. So speculators analyze graphs in order to find patterns, right? So graphs vary by time frame as well. That's another thing that I want to point out. When you look at an economic or at a price graph, it's going to be in a certain time frame. It could be a daily graph, so it could be the price during the day that asset was trading at. It could be a monthly graph. So what it does is it takes all the days within the month and averages them out to a price, and then it plots that price over time. Okay. But you use that in order to make predictions in the future price. Like I said, as you notice, you don't have to look at any report or anything like that. All you have to do is look at the graph, and you'll be able to make your analysis based on that graph. The best chart to do this with is a candlestick chart. Most people are pretty much familiar with a line graph, but a line graph is okay if you want to just get a quick snapshot of something. It's really just for a trend. We'll talk about what the trend really is a little bit later, but it's really just a good way to see what's happening with the trend, right? There's not a whole lot of information that you can infer from a line chart. So this is what a candlestick chart looks like, right? So this is what's known as a candle. So right here, what's called the body, right? So you have the majority of the trading in here. So this part, if you can see on the mouse, it's the open. So this is where the price started at, okay? This is the close, or where the price finished at. Now, like I said, graphs vary by time. So this right here could represent 1 day. This could represent 1 month. It could represent 5 minutes. It can even represent 1 minute. But it represents an amount of time. And so you have these that carry on kind of throughout time. So basically, the price started here. And let's say this is a daily candlestick. So in 1 day, the price started here. At the end of the day, it was here, right? And let's say there's another candlestick next to it. That candlestick would open right here. And if it went up, it would close right here. Or if it went down, it would close somewhere down here. But you kind of get the idea of what a candlestick is. These right here are called wicks or shadows, which is why it's called a candle. Don't really pay too much attention to this, but this is basically during that day, this was the lowest that the price got to. And this was the absolute highest that the price got to. So from this part to this part was the complete fluctuation of the price in the day. All right. So this is how much the price changed just in 1 day. And you're going to use this, like I said, so you're going to use this historical pattern to make predictions. It's gonna develop what's called a trend. So when you have a bunch of greens together, you have what's known as an uptrend. So you're gonna have a green here, and that price is gonna open here, then close here, and then the next one's gonna open here and close here. And you kind of develop a pattern as you kind of go out. And the same thing for the red candlestick, right? So this is an actual platform. This is a screenshot that I took from my Forex trading platform. So let's go over a couple of things, right? So right here in the red box, you have all the price quotes, right? So these are the exchange rates between, you said, I have CAD, JPY, that's Japanese yen, CHF is Swiss franc. You're gonna have to learn these individual symbols, just like you guys gonna learn chart symbols too, right? F is Facebook, things like that. So these right here are all the exchange rates. You have the bid and the ask. So this is a more simple outlay for the exchange rate. Just it's compared to the more technical one that I showed you guys a few examples earlier. So you have the bid price, the price to buy the currency, the ask price, the price to sell the currency. Right here, this is what the currency is. So this is the USD JPY, or the US dollar Japanese yen currency pair. It's the daily. So each one of these candles represents a day. So this was 1, 2, 3, 4, 5, 6, 7. So from here to here was 1 week, right? And so from here to here is another week, so on and so forth. So you can kind of get a sense of what I mean by things develop a trend. And this is why candlesticks are better outlay than a line graph, because with the line graph, all you would have is one simple line, right? But from here, you can infer a lot more information from it. We're going to kind of get into that a little more. So from here, this is where you would pick, like I said, you would pick the time frame. You can pick 1 minute, 5 minutes, 15 minutes, 30, all the way up to 1 month, right? So you can get a lot of data from this chart right here. So which is why I said, once again, you don't always have to read economic reports to get information. This right here, this little small black box, this is the current price, right? This is the recent date. As you guys can see, this is just a couple days ago. So, and it's the weekend, so there isn't a price right here. On Monday, there probably will be. But anyways, this is the price right now of the dollar yen currency pair. So as you notice, you guys may have noticed before that the euro was the first one when we started talking about that currency pair, right? But the euro was considered the quoting or the base currency. So here, the dollar is considered the base. Oh, sorry about that, guys. So here, the dollar is the base currency and the yen is the quoting currency. So $1 is worth 112 yen. That makes sense? Say it again. $1 is worth 112 yen. Right? So these are the fluctuations in price. So we're going to talk about some terms now. This is a graph. This isn't the graph from before, if I'm not mistaken. This is the daily Mexican peso graph. Right. So one term that we're going to get into is what's called support. Right. So support is basically, a level that the price doesn't go below. Right. So as you can see, the price started going down, then it started going up, right? And then it came down, and then it went up, and then it came down again, right? So it would say like, so if you're reading a report, you'll say, it will be like, yeah, the price was ranging, and let's say you were right here. It would say it tested a support line of, let's pretend this is 1.2, right? What that means is basically, like I said, it's a historic reference, right? So you can say historically, the market was trying to like push the price, past or below $1.20, but it couldn't. It hit $1.20, and then the market reacted, and then it tried again to push it past $1.20, and it almost came close, and it came close to a little bit in the wick, but it pushed it right back up again. Right. So you can see that this is kind of a reference. This is how you make a prediction. So in order to put this into real terms, you would say, well, if I'm going to guess, I'm going to say that the price is not going to go below $1.20. Right. So now you see how you kind of use historic trends to make guesses. So let's use this one, for example. So we could say this was a support line right here, right? Because the price kind of came down right here and hit right here, right? And came back up, right? And then it hit it again even, right? You could draw support lines, though, pretty much anywhere. So the thing about what's called charting, right? Charting is basically looking at a chart to make an analysis. The thing about charting is it's more of an art than a science. There's no specific finite way to say that there's a definite way to make a support line or a definite way to determine a trend or anything like that, right? It's like I said, it's more of an art than a science, right? So here's another support line, all right? So we have this right here. So you'll say, all right, so now we have this support is, let's say this was $1.20. Let's say this was $1.30. So now you say the supporters, it's starting to kind of go up a little bit. So my guess is, even though the price came down, in the future, it's probably going to start going back up because it tested the support of, that's another thing. It's called testing, right? So if it goes and it kind of plays around with this, and this one, it actually broke it a little bit. So it's if it tested this support line at 120, and then came down, it tested the support line at 120 again, and there 1.2 again, and then it goes up to 1.3, and it tests that again. You pretty much get a more broad picture that the overall price is going to start doing this, right? It's going to start going up, right? So that's how you would start making your trades. You would say, I think that this currency is going to appreciate relative to the other. Okay, when you say something's going to appreciate, right? So let's pretend, for example, we're going to talk about the euro dollar again. If I say that the dollar is going to appreciate, that means that I'm saying that the euro is going to do the opposite and depreciate, right? Vice versa. If the euro is going to appreciate, the dollar is going to depreciate. Okay, and that determines the fluctuation within the exchange rate, right? The appreciation and depreciation of one currency to another to determine the price. So if you say that this currency is going to appreciate, you're basically saying that its price relative to the other is going to start getting stronger over time. So the opposite of support is resistance, right? So it's literally the complete opposite, right? So this line right here would be a resistance. So now you kind of get a broad picture. So let's say you were, I don't know, let's say you were right here, right? Or let's say you were right here. and you were saying, all right, so the market kind of played around a little bit and it tested this support line and it came back up to here and it fell down to about right here. And it looks like it's going to test this resistance again. So I think it's going to shoot back up to, or excuse me, it's going to test this support level right here. And I think it's going to go somewhere in here, right? So if you were to go right here, and we're going to look back into the future and pretend or go back into the past and pretend you're looking into the future. You're going to say that in the future, I think that the price is going to end right here, right? So if you can guess, you would say at this level, I'm going to sell, because if I don't, I'm going to lose money. Okay. So, if the price was here to here, you lost money. All right. So now to go back a little bit, you can see a whole bunch of support and resistance lines on here. So this right here can be a support. This huge one right here could be a resistance, right? You can also do it diagonally. So you can go draw a line from here to here as a support. You could draw a line from here to here as a resistance, okay? So I'm gonna try to speed through this a little bit, guys. I don't want to take up your whole day. So this is the trend, right? So the trend is basically the direction of the market. So if you're saying it's a downtrending market, basically that means that the price is falling, right? The opposite of that is an uptrending market. So the price is rising. And as you can see from here, it looks like we have an uptrending market, all right? You also have what's known as a breakout, okay? So a breakout is if a support or resistance level is broken, okay? So look right here. You see where the price kind of came down and it tested this support level again, and it hit this resistance and it actually broke past it. It's called a breakout. So you hear that in the news. Euro dollar is expected to test support at 120, but may break out to 1.25. What it means is it could hit this level, but if it goes past it, it's going to go past it to 1.25 or break out to 1.25. Once again, this is an art, not a science. You could have did a breakout anywhere. You could have drawn a support or resistance anywhere. You could have used this right here as a support. This right here is a resistance, okay? This is not a science, guys. And this was, like I said, it was the dollar peso exchange rate. So basically what this means is that the dollar is appreciating relative to the peso. Okay, so anytime you see a red line, that means that the peso got stronger. Anytime you see a green line, that means that a green bar, that means the dollar got stronger. This is how you prevent yourself from losing money, right? So you have these types of orders. A market order is when you buy at the current price. So the euro dollar is at $1.20 right now. You want to buy it, bam, okay? You can also use what's called the limit order. So you buy right now, right? You say, I think that the price, so look at this example right here, guys, where you see the mouse hovering over. Say, I see that the price is right here. I think it's going to fall a little lower and then pick back up again. So you would set a buy limit. The great part about a buy limit is it's done without you having to be there. So one good thing that you can do is you can wake up in the morning, set all your limits and get all your securities in place, and go about your day. You don't even have to watch your computer, and things will operate on their own. Your system will automatically buy and sell things on their own. And there's things you can do like that with stocks as well. A sell limit is just the opposite. You say, it's right here. I think it's going to go up a little bit and then fall. We're not going to talk about short selling a currency, but it is possible to make money if you were to sell a currency at this price and then buy it right here. You capture this profit. Once again, I'm not going to go into that. Look that up on your own, right? But you also have a stop loss order, okay? So a stop loss is, let's say it's right here and the market's going to do the opposite. It basically says, let's say you bought a currency. It'll say, all right, the currency is not going to go past, if it's at 1.2, it's not going to go past 1.2005. So I'm going to set that as a stop order, and it'll automatically sell however much you want it to sell at that order, right? When you start getting into your demo, play around with this, all right? Play around with limit orders and stop orders, because they're going to save your life. You can't monitor your computer 24 hours a day. Like I said, the market operates 24 hours a day, right? So the prices change 24 hours a day. So you can't sit there. You don't have time to sit at your computer 24 hours a day. This is the way that you can mitigate your losses. And this is why you kind of have to use a little bit of technical analysis, right? So this is the last slide, guys. We're going to wrap it up here. Most investors use a combination of technical and fundamental analysis. What does that mean? They look at reports, they look at data, they look at the news, and then they look at the chart, and they make predictions combining both. So fundamental and technical analysis applies to the stock market as well. You could look at a candlestick chart for Facebook. You can look at a candlestick chart for Microsoft. I mean, there's a whole wide range of things that you could find out from a candlestick chart from I mean, not even just from Forex. You can use the stock market as well. The strategy that you use is going to be determined by you. All right. And I say the strategy because we all have a pattern and we all have things that we like and don't like. Okay. Maybe you decide, you know what? I don't really want to focus too much on fundamental analysis, but I'm going to put more of my emphasis on technical analysis, or maybe vice versa. Maybe charts make absolutely no sense to you, but you just get a gut feeling about when things are going to change and move, and you follow your gut, and every time you do it, it tends to work out for you. You could use that as well. So like I said, use whatever you want to. You're going to see, as you guys start getting into your journey, you're going to see people talk about, oh, I did this and this was the strategy that I used and it made me, I profited, this much. Don't always take that as like a finite, indefinite, thing. That doesn't mean that is going to work for everybody. Okay. And like I said right here, use whatever works for you. Okay. So if you develop a strategy and it doesn't work, stop doing it. Okay. Also, though, take into account, give yourself some time, give yourself a learning curve. Just because you do something a couple times and it doesn't work doesn't mean that it's just a failure, and you should just, let it go altogether. Don't hack off your arm. It's not that serious. Play with a little bit. And over time, if you realize that after a while, there's better tools at your disposal, use those instead. And I'm also not saying don't take people's advice. All right. People have been successful and obviously they know what they're doing. So use their advice for sure. Just don't take it as some for sure guaranteed resource because they did it. You can do it too. All right. So that's it for you guys. I really hope that all of you enjoyed this. I hope that you found it informative. I hope that all of you will come back next week. Like I said, I'm going to get into a lot more in-depth analysis and really start talking about a lot of these reports that we went over today. So with that being said, I wish you guys the best. Have a great week. Happy holidays. See you later.